morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Partially immune, the Supreme Court rules that Trump has some immunity over his criminal charges. Democrats rush to confirm Biden as their nominee. Fed Chair Powell and ECB President Lagarde speak in Sintra after policymakers signal they need to see more evidence before cutting rates. And ready to make a bid, billionaire Barry Diller is reportedly in talks for control of Paramount following the failed attempt by Skydance. Good morning, Manus.
Danny, good morning. We deal with a triptych of politics and what it means for global markets. There's a dislocation when it comes to the yield curve spiking. We'll talk more about that in a moment. 445 is where you are on 10s at the moment. The yield curve moves by over 12 basis points at one juncture. Yes, the stocks this morning. Again, I talked about a triptych of politics. France, the UK and the USA. It's going to be about the flow of capital. That's representative in the bond market this morning and over the past couple of days. JP Morgan has a note out saying this is as good as it gets on equities going into the second half of the year. You're going to have a myriad of headwinds on growth. Tesla this morning, keep an eye on that. You're looking at Tesla. Let me just see. I think we're down 1% at the moment on Tesla. Nvidia also dropping a little bit. And when it comes to the dollar, this is what we've got for you. Dollar yen again back at a 38-year low. The dollar is stronger on the prospect of a Trump victory and a Republican sweep. But this dollar is trending higher, the yen at a 38-year low. And again, the market is really reflecting on what does this partial immunity for Trump mean as we run up further to the election. A little bit of breaking news from the EU on the inflation side. Danny, what have we got?
So we have inflation, CPI, Manus, coming in line year over year, 2.5%. The estimate was for 2.5%. So good news for the ECB on that progress. Maybe the slight bad news here, Manus, is what core looks like. Core coming in 2.9%. The estimate had been for slightly lower than that, 2.8%. So 2.9% also matches the prior month. And so perhaps shows a stalling out of services inflation. We need to look down at the components, but we heard from the chief economist, Philip Lane, speaking with Francine over in Sintra, basically saying that services is the issue. It is too early to tell whether it's coming down. The fact that core inflation looks sticky might point to that.
And as he's actually made the point very clearly just a moment ago, that the disinflation, which is there, they're going to be in a different position in a year's time, but it's whether the services inflation has still got that lag in it, unlike the manufacturing side, whether it's legacy or persistent.
Yeah, correct. And just to go over the month-over-month numbers, 0%, so flat there for CPI. Again, 2.5% is the headline, 2.9 the core. And as we're saying, they've all been in Central, Manus. And ECB President Lagarde spoke yesterday, saying that the central bank doesn't yet have sufficient evidence that inflation threats have passed.
We are still facing several uncertainties regarding future inflation, especially in terms of how the nexus of profits, wages and productivity will evolve, and whether the economy will be hit by new supply-side shocks. And it will take time for us to gather sufficient data to be certain that the risks of above-target inflation have passed.
Let's get to Sintra now. Over there is Bloomberg's Francine Lacqua. Francine, you've been doing great work there. I was just talking to Manus about that interview with Philip Lane and the need for more evidence. So we have a little bit more evidence. We have CPI numbers for the euro area. Do you think it'll affect at all some of the policymakers you've been speaking to, their thinking?
Well, good morning to both of you. And it's very clear that, yes, of course, at the margins, it will impact what they'll say, going forward. But there's been a concerted effort from Christine Lagarde yesterday. I have to say it was a fine speech also because there were many football analogies. I think she finished it off by saying, look, if you go back to Sir Bobby Robinson, he said the first 90 minutes of the football game are important. And that was intimating that also, look, whatever happens, the ECB will not keep its eyes off inflation. So she was also intimating that it's a little bit too soon, even if there were encouraging figures in some parts in inflation today of when they cut next. We had the similar message from Philip Lane. I mean, he just went to say, look, if you look at services inflation, we just need a little bit more time to actually understand what's going on. So possibly July could be taken off the table. Again, I feel like when you speak to Torsten Slok, who tried to put everything together, we do have the big monetary policy panel a little bit later on, that maybe we're in now an era of higher for longer, also because of the politics, also because of all of the uncertainty in geopolitics, which I have to say everyone's talking about in the corridors, but no one will really go on the record with it.
Yeah, and therein lies the problem. Everybody's sort of whispering about what the possible changes are politically, not just here in the United States, but also in the second round in France. And of course, you've got the UK as well. You talked about the panel a little bit later on. And here's the conundrum for Powell. What do we expect him to say? Lagarde has again, along with Lane, asked for more time to consider the data. Do you think that Powell will invoke the same spirit of uncertainty?
I think so, Manus. I think both of them will try and push back against giving the market some kind of very clear time frame. Now, remember, it started kind of at the end of December, where the ECB was very clear on when they would cut. June was always the goal point. And through various speeches, through various forums, they made that very clear. We've seen also from Jay Powell really going through great lengths of trying not to give this clear timeline to the markets. And we've now seen the same from the ECB. You could argue that's because uncertainty has actually increased because of the politics. But you could also argue that they're just waiting for the data points. Now, I spoke to Austin Goolsbee, the Chicago Fed president, and he was very careful. I mean, I asked him 3 times whether he saw 2 cuts from the Fed this year and whether once it's cut, then it's cut after cut like in previous cycles. And he was very, very careful in basically saying that he didn't want to game the market, that the market has to do their own work. But for the moment, they're very data dependent.
Okay, well, certainly a building narrative is it's going to be a much shallower cutting regime that we go into if and when that starts at all this year. Francine, thank you very much. Francine Lacqua on location in Sintra, and a feast of interviews past, and there will be more to come. Our next guest writes this: although the prospects for interest rate cuts were an important driver of the market rally in the first half of 2024, looking ahead, the rationale for the delay in the Fed rate cuts, it's critical to the equity outlook. Our guest this morning is Shah, Chief Global Strategist over at Principal Asset Management. Seema, good to see you this morning. Again, you lay the groundwork very clearly, which is the rationale for holding off on cuts is because of a strong economy. That's good for risk. That's good for equities. That's the soft landing. But what do you make of the thesis that, look, you're going to run into massive political volatility headwinds and that this is as good as it gets for equities? Do you fight back against that? Good morning.
Good morning. Yeah, I do. I mean, look, this isn't new. We've seen election after election that there's always going to be volatility. There's a lot of uncertainty. Polls have not been the best predictors as well of some of the results. So I think it's really actually important that investors try and look through some of that election noise and really stay focused on the fundamentals. Now, there has been obviously some interesting developments with regards to thinking about what the inflation outlook would be under a new government in the US. And certainly that is the kind of thing that could sway the way that investors start to think about interest rate cuts going forward, and of course the equity market. But I think it's a little bit too early. There's a lot of promises made in the run-up to an election. Whether or not it comes through is always going to be a slightly different question.
Seema, I'm with you. I was talking to Manus about it this morning. Not only is it really early, but we're also so bad at figuring out the path of inflation. I think we've learned that lesson over and over again for the past 4 years. But for those that are calling for curve steepeners, I mean, there are so many of them now. Goldman, Morgan Stanley, BNP, Barclays, all saying go to curve steepeners. Is there a tactical play to be had that at least you want to hop on this bandwagon for now and see how it plays out?
So I think that there is something to be said about the idea that with this, you know, and not just, of course, in the US, but actually globally, that there is so much focus on fiscal discipline. Budget deficits are significantly larger post-COVID, and governments are having to think about what they can do. And of course, they want to provide their electorate with some kind of boost to growth, but they're very much limited. So actually, when we think about this, yes, there's probably some upward pressure on longer-term yields. But when you're combining that with the potential for rate cuts, from our perspective, this just means that treasuries in particular are quite range-bound. So where we are today, I think, is bang in the middle of that range. You could see a little bit upward movement. But then as soon as you get clear indication that the Fed is close to cutting rates, then I would expect there to be renewed downward pressure.
How close are we to that cutting of rates? We've just had the inflation data in Europe, and again, they're all requesting time from the market. And the question for the market is, you know, we go into this back half of the year with politics being the dominant theme and disinflation. How convinced are you that the disinflation theme will continue in the United States and allow them to cut twice? Francine had a struggle to get Goolsbee to sort of go with her on the journey to 2 cuts.
Yeah, so we have got some confidence. I wouldn't say that it's a huge amount of conviction at this point in time, simply because when we're thinking about the inflation numbers, you were looking at the subsectors of inflation, which inevitably does create a lot of uncertainty with regards to how that's going to pan out. But if you take a step back and look at the way that the economy is evolving, we do still expect there to be a soft landing, but that does also mean a slight softening in growth, which should put downward pressure on inflation. So from our perspective, it's still a September hike is still on the table. A lot of the narrative that you're seeing coming out from central bankers today, this week from Sintra, we think is about taking off that July cut from the table. Because as I said, there's a lot of uncertainty. They need to see how the data plays out. But certainly for us, as we look forward over the coming months, we think there will be sufficient evidence to give them that comfort to begin cuts come September.
Seema, we started out by incorporating this into your equity outlook. One of the things I've been shocked by is every morning so far this week, I've woken up and I've checked NVIDIA, which appears to be the thing to do these days. And it has been down. Yesterday, it barely eked out a gain, just about 0.5%. Yet the Mag 7 hit another all-time high. The equity market is being supported, even though NVIDIA looks to kind of be lagging around. Do you think something is happening? Is that meaningful to you? Could this be a momentum shift, or is it a breather in a continuing story of there is no alternative to NVIDIA?
I mean, I think at this point in time, it's been interesting because we came into 2024 and the general consensus was that this would be a very different year to 2023, which was, of course, very much driven by the Mag 7. And then fast forward 6 months and here we are again. It looks a lot like 2023, where the Mag 7 are really the only game in town. Now, if we're looking forward again and we think that, yes, growth is slowing, but it's still solid, then you should see, as we've already seen actually in Q1 earnings, that good performance is spreading out to a number of different sectors. And that should provide some kind of support for the broader market. Of course, it probably wouldn't be enough if the Mag 7 is really going to hit a wall. So there is a concentration risk. We do think that you should actually start thinking outside the US, where the opportunities there to provide that little bit of diversification against the risk that valuations are getting very frothy and you are seeing some nervousness enter the market about those Mag 7.
Well, there's no doubt about it. Here in the US, we have this, as David Kelly said yesterday, we have this euphoria at the top, but that that excitement, that euphoria is not stretching out to the broader market. When you stand back and look at the next 6 months, what is the most important pillar in the portfolio that I need to have? Is it a hedge against a lack of disinflation? Is it a hedge against concentration risk in the United States of America?
So I think it's important that you don't just, obviously I don't think there's one segment. I think at this point in time when you have got valuations in certain parts of the market which are very, very strong, you have to have an array of ideas within the portfolio. So I mean, I think, of course, you should have exposure to those big tech names, and I think it's a time to reduce it, but also not be looking to increase it. As I said before, international exposure is going to be really key. So looking outside of those tech sectors, outside the US, into various parts of the market, if you're thinking about India to Korea to parts of Latin America. And then with fixed income, there is a chance that you get a bit of a slowdown. You are seeing more concerns creep into investors' discussions that they're looking at a potential hard landing. That is creeping in. So having exposure to fixed income that can give you that protection. And then, Manus, to your point, inflation concerns still there. So we have got exposure to real assets. So we're thinking more commodities and hedge funds at this point in time.
Feels like a repeat of 2023 then in more ways than one if we're starting that hard landing conversation again. Seema, it is always such a pleasure to have you on. Seema Shah of Principal Asset Management. Okay, Manus, let's get to some of the other top stories that are trending on the terminal this morning. Bridgewater is launching a $2 billion fund that uses machine learning in its decision-making. Sources say the fund began trading Monday with capital from more than half a dozen clients. The hedge fund giant is leading on its own tech, but the new fund will also broaden to include other models from OpenAI, Anthropic, and Perplexity.
Northern Data is said to be considering a U.S. IPO of its combined AI, cloud computing, and data center businesses. The potential listing could fetch valuations as much as $16 billion and is targeting a debut on the NASDAQ as early as next year. Coming up on the show, the U.S. Supreme Court says Trump has some immunity from prosecution, a decision with consequences for the election. Context matters on Bloomberg.
The American people must decide Trump's embrace of violence to preserve his power is acceptable. Perhaps most importantly, American people must decide they want to entrust the president once again, the presidency, to Donald Trump, now knowing he'll be even more emboldened to do whatever he pleases whenever he wants to do it.
President Joe Biden there commenting on the news of the Supreme Court granting Donald Trump partial immunity from prosecution. The former U.S. president posted his own reaction to the news on Truth Social, calling for the decision a big win for our Constitution and democracy, saying he was proud to be an American. So let's start this conversation with Kriti Gupta. She joins us now. Kriti, look, this ruling passes the baton back from the Supreme Court down to the lower court. But what's it going to mean for the overall ruling? What's it going to mean for Trump's trial on charges relating to overturning the 2020 election result?
Well, I think for our international audience, what we need to know is this just pushes out the timeline even further. So any outcome or even the start of a trial is likely to begin after Election Day in the States. What you need to know here is that now that it has been kicked down to the lower courts, the federal court judge in particular now has to kind of do the parsing out between what is an official act and what is a private act. Remember, we are in uncharted territory when it comes to legal precedent. No precedent has ever had these dealings. What that means, though, is going to take a couple of weeks, potentially months, to kind of create that difference between what is qualified as presidential duties versus what is a private citizen's duties. That being said, even then, the judge has said that she was planning in previous iterations of this conversation to have 2 to 3 months of prep time and then potentially 3 months of trial time.
Kriti, I mean, as Manus and I have been talking to people, there's been a shift where people are more willing to start to price in a Trump presidency. And after the debate and what has been called the disastrous result from Joe Biden, this was just out about 18 minutes ago from the politics team, that Joe Biden's campaign has raised $127 million in June. That is their best fundraising month of the cycle, and it includes $38 million raised in the 4 days starting Thursday. So clearly a lot of money raised after the debate. The Democrats will obviously see the Trump ruling as a blow. But what does this mean with the money raised and some of the news and noise around getting him confirmed sooner as the party's candidate for the team, for the Democrats, and sticking with Joe Biden?
So let's start with the campaign performance specifically, because this is something that the Biden administration from the gates had actually said, and the campaign, I should say, had said even just in the hours after the debate itself. Remember, Joe Biden went from Atlanta to a rally in North Carolina straight to New York and New Jersey, again to court, especially some of the big Wall Street donors that he needed to court at fundraisers hosted by New Jersey Governor Phil Murphy. So this is kind of in line with what we've been hearing out of the campaign. As far as the timeline moving forward, there was always going to be a virtual roll call for the Democratic nominee. And this wasn't really an issue because President Biden was the presumptive nominee that is in line to meet that Ohio ballot deadline of August 7th. That being said, the question of the timing was still uncertain. Now it looks like there's some reports that's going to be shooting for in and around July 21st, in which case it's basically going to be confirming what we already know, which is that a lot of the electoral votes have already been promised to Joe Biden simply because he won those swing states.
OK, well, it's certainly trying to batten down the hatches and reduce the overall risk. I mean, they're in full defense mode at the moment. I think Terry Haynes' line this morning is the case about the limits of POTUS immunity is a bipartisan parade of vanities and horribles that today debase U.S. politics. Kriti, thank you very much. Great work there, putting the context around it. Coming up on the show with Danny and I, the student has surpassed the teacher. We discuss Bill Gates being the 6th richest person in the world. Who could chase him? There you go, Mr. Ballmer. There you go. We'll talk about him in a moment. What's on your front pages this morning? This is what is making headlines around the world. First up, of course, it's the hurricane. CNN talks about Hurricane Beryl charging towards Jamaica at a record-breaking Category 5 storm, Danny, after leaving the Caribbean islands in ruins. Strongest storm ever at this time of the year in the Atlantic, 165 miles wins. Oil is bid on the back of this, up 0.7%. Obviously, a big concern there in the region.
This could also be moving oil. This one on the Financial Times on the front page is writing that Iran could use all means to back Hezbollah if Israel launches a full-blown war. That's according to an aide of the Iranian supreme leader. We know Israel has been more forcefully attacking Hezbollah.
Yeah.
There's this concern that it escalates thing, but apparently they've told Iran has told the FT that they're not interested in a regional war.
And finally, we have a story about Steve Ballmer. He is now richer than Bill Gates. This comes down to, of course, he was the first CEO over at Microsoft. This is called stay and hold, buy and hold, or get given and hold, which is Microsoft CEO Ballmer. He's worth 157 billion versus Gates. He diversified 156.7 billion. Diversification doesn't always work.
I was going to say, this is like the perfect example of how messed up this market is. Maybe not messed up perfect for Steve Ballmer, I should say.
Yes.
But diversification isn't working right now. You just got to own one of the Mag 7s, which, hey, Microsoft is in. And if you just ride that bad boy to the top, you too can be richer than Bill Gates.
There you go. I mean, I tell you what, I think we're going to be working a few more 5 a.m.s and a few more briefs before we hit these heady levels. But of course, we're going to talk a little bit about the NBA in a moment. But of course, he bought the Clippers. That was a long time ago.
He did buy the Clippers. Some
Mr.
sports
Ballmer, that
news.
is.
We're going to have some sports news for you later in the show. Stick around for
She's
that. But
teaching me
first,
about American sports.
I am. It's a long road, but we're getting there. From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Partially immune, the Supreme Court rules that Trump has some immunity over his criminal charges. Democrats rush to confirm Biden as their nominee. The Fed Chair Powell and ECB President Lagarde speak in Sintra after policymakers signal they need more evidence before cutting. And ready to make a bid. Billionaire Barry Diller is reportedly in talks for control of, you got it, Paramount, following the failed attempt by Skydance.
Manus, I think the best person to really encapsulate the environment we're in is Lori Calvasina over at RBC. Raised her price target, she says nervously, but called it a fog for 2024 and 2025. We're seeing some of that fog play out, whether it's trying to figure out how policy applies. S&P 500 futures, they are weaker this morning, down by 0.4%. NVIDIA leads the market lower. It was barely up yesterday, even though the Mag 7 hit an all-time high. It is a busy calendar for you for these bond markets. We have the ECB and Powell speaking at Sintra in Portugal, UK elections on Thursday, jobs data Friday, and plenty in between. Yields basically unchanged. 4.45% is where we stand. The euro is weaker this morning, down by about 0.2%. But Manus, again, I think it's really interesting talking to Seema Shah from Principal about what inflationary impact Trump might have, because there's a willingness now to actually speak about it. After the debate performance on Thursday, you're getting these calls come in, call after call, about inflation and about Trump.
Well, there's certainly a frenetic response. You know, you can definitely see that. And we're going to talk to our next guest about this. But there's a frenzy of action, not just even on the steepeners, but on the outrights as well, and on the break-evens. And we're talking to different people on the IB, and they talk about perhaps keep an eye more so on the 5-year and the 10-year break-evens as more of a prescient issue for the bond market. But there's a real frenzy to the notes, isn't there?
Yeah, but I get back to this thing of we are so bad at trying to figure out the trajectory of inflation. If anything, the past 4 years have taught us that. And also, how do you really figure out?
Not a lot of humility, though, in the average bond trader, though, is there, for getting inflation wrong?
Oh, yeah. No, they're the if anyone has
Have you met a humble bond trader?
Have you met a humble equity trader? Comparatively, they're a little bit humble. No, but Manus, to your point, I mean, you can see it in the yield curve. I think we have this chart. There has been a shift since the debate. The yield curve, if you just look at that top panel there, it's gone up by about 13 basis points in 3 days. The steepeners have put on, it has been bear steepening, on this assumption that Trump policies would invoke some inflation. Joining us now is John Ryding, Chief Economic Advisor at Brean Capital. I mean, John, the calls are one after another. BNP, Goldman, Morgan Stanley, Barclays, look at curve steepeners. There's going to be inflation because Trump wants maybe a dovish central banker and is going to do tariffs, tax cuts, inflationary policies. Are you among those who see that?
Well, inflation's, as Milton Friedman famously said, is a monetary phenomenon. So the Federal Reserve is the bulwark that the economy has against inflation. if it does its job. Now, it can make mistakes. It made a big mistake in 2021 by continuing to ease, by buying bonds and saying that the inflation pickup was transitory. And it has learned from that. And now, arguably, on the other side, is a little too resistant to cutting interest rates. But the makeup of the Federal Reserve can change. Now, in the first Trump administration, Trump didn't get a carte blanche, as it were, from the Senate, and some of his nominees did not get through. But when it comes to trading bonds, interestingly enough, it's not been inflation break-evens that has driven the bond market in recent years. It has been the real yield. And the real yield, for me, is the proxy of the price that has to be paid to keep inflation in check. So you can, in the big picture, you can say the bond market remains relatively comfortable with the idea that inflation is going to be somewhere close to 2% over the next 10 years, and that's a good thing. But it's also saying, and was saying before the debate performance and before late last year, that we may need real yields above 2%. We may need a real Fed funds rate above 2% to keep inflation contained.
Well, I mean, the anecdote in regards to break-evens comes through from various people with real money in the game. They say the Fed only has a problem if the break-evens materially break higher from where we are at the moment. It becomes a little bit more uncomfortable. So just some context around that. Give us your position. I mean, from your notes, it sounds as if I said to you, oh, you're a disinflation bull. You're very bullish on the disinflation. Well, that's a little bit overstating the case. So restrain my enthusiasm.
Well, there was a narrative, and as President Bostic of the Atlanta Fed said last week, he said that some people had said the disinflation progress in the first quarter had stalled out. But that was a poor reading of the data. It was getting too caught up on high-frequency changes in the inflation rate when those numbers, we believe, are distorted by seasonal adjustments that haven't caught up with the price dynamics. So actually, if you just looked at the year-over-years, inflation, the decline in inflation slowed, but did not stop. And the latest reading for May, where core PC price inflation, that's excluding food and energy, year over year slowed from 2.8% to 2.6%, was a number that really drove home that this decline in inflation remains intact. Now, the key thing for the Fed is to pull off the landing at 2% and not to undershoot. And that's why at some point this year, I actually think the Fed has to cut rates. I think that first rate cut comes in September, because otherwise, as inflation declines and interest rates remain unchanged, real interest rates continue to rise.
Right.
That makes policy tighter, and that pushes down more on inflation. So the key for the Fed is to communicate, and I think President Bostic took a first step last week, but to communicate that we can cut interest rates, but that's not a real easing of policy, and we are still trying to get inflation down.
And I know you make that distinction by saying this is a 25, 50 basis point tweak. This is not the start of a cutting cycle. I know that's what you see, but my question for you is, rates on the way up, this has been an economy that's been less sensitive to it. So how sensitive is the economy to a tweak, to 25 to 50 basis points? Do we really understand the impact that will have on what America's economy looks like in 2025, as Lori Calvasina calls it, the fog of 2025?
But the controlling inflation isn't necessarily about controlling the economy. It's not necessarily about trying to slow economic growth. It's about setting the framework where if a price shock comes along, like, for example, a hypothetical tariff, that shock isn't transmitted into the general level of prices. Now, we had those tariff increases in the first Trump administration, and it didn't feed through to a problematic inflation rate. Whereas during the pandemic, import price shocks, supply chain shocks fed into prices that were much broader than the area of the economy that they initially hit. So I think those tweaks are about, in a sense, regulating the inflation rate. And yes, we don't fully know how things work. We don't fully understand how the economy has withstood the degree and speed with which interest rates came up in 2022 and then in 2023, though I suspect it's something to do with the animal spirits and something that when you talk about the Magnificent Seven stocks, that is playing some role in an economy that is right now less sensitive to interest rates.
Do you see any kind of, I've heard various people say there is no mania. in stocks. Our own Gina Marsden-Adams, she was at the Bloomberg Invest conference last week. It's the strangest things you click on. I clicked on that, and it was that very piece. There is no mania in markets relative to the benchmarks that they use. We check NVIDIA pretty much every morning now. We check the Mag 7 every day. Do you feel a sense of mania in equity markets at all? There's a wealth effect, but is there a mania?
Well, the equity market has defied my expectations, and the question is why? How is it that we have been able to raise the discount rate of the market uses to discount future profits so much, and for that to have not had a material impact on the equity market? In fact, quite the reverse. One just would imagine, and it's probably something that keeps the Fed a little bit cautious in thinking about interest rate cuts. You know, what would happen if the Fed were to make a real material move to lower interest rates, not just a tweak? So I don't know whether there's a mania in stocks. I don't know what any individual company is worth, and I don't know how the future of AI and which companies will benefit from it will play out. But right now, one has to say that tried and tested signals of recessions, particularly the inverted yield curve that you made reference to earlier, that inverted in November of 2022 now.
We're almost on the 2-year anniversary.
You know, the average time from a yield curve inversion to a recession is about 13 months. And so you say, here we are, we're
John,
well
can
along.
I just jump in there, because there's been a lot of signals that have been confusing to people. The consumer has been one of them. The yield curve is another part of them. Do we have the right tools right now to analyze this? You talked in the break about the high frequency data being misleading. Is there something wrong about the data points we're using and thus the Fed is using?
I don't. Well, the data points being wrong. You know, we have two measures of the economy's gross domestic product, and one actually, from the income side, actually did pretty much touch a recession-like indicator a year ago. But I think the question is, what is it about the dynamic of the economy that is different? And what is different this time is that profit margins at the aggregate level did not get squeezed. And so the question is, how are we pulling off this immaculate disinflation where prices are coming down, the labor market's tight, wage increases remain relatively elevated, though they are slowing, and profits didn't get squeezed? And the answer is we've had a renaissance in productivity growth. And if that continues, then the economy can withstand higher interest rates.
Well, certainly the profits and the margins are there to support in some way that mania or that enthusiasm, if you want to use a more restrained word, in the equity market. Look, great conversation, John. Good to have you with us. And we'll find out whether we're still inverted and having that anniversary party. Maybe come and join us on that day a little bit later in the year. John Ryding there of Brean Capital. With Danny and myself, breaking down the bond markets. Context matters on Bloomberg. Good morning from a beautiful New York. Bloomberg Brief. I'm Manus Kearney alongside Danny Berger in New York. So the analysts are anticipating a slowdown in the sales number for Tesla. The EV giant is set to reveal its second quarter deliveries in just a few hours. A slump would be the second consecutive quarterly decline, the company's first since 2012. Craig Trudell is with us now. Craig, all the price cuts around the world is not enough to save Tesla for its second consecutive quarter of a slump. Is that what we expect?
Yeah, price elasticity, I guess, is the focus today, and just how much there is left there for Tesla. I think there are some real doubts just based on the numbers that we did see, in the lead up to June. There were real signs of slowdown in China that carried over from the first quarter of the year. Also in Europe, a really sort of bleak results that you saw reported from the industry bodies where Tesla did not have a good first couple of months of the quarter. So, on the last quarterly earnings call, we did hear from Elon Musk say that he thought the second quarter would be much better. I think on a sequential basis, there is an expectation that we will see greater sales from the first relative to the first quarter, but that's kind of par for the course and what you would expect. The first quarter is always seasonally slower for automakers, so I do think that the company will have sort of real questions to answer in terms of, what exactly is going on with demand and how soon can they get newer and more affordable models to market.
It feels like sometimes we care about this, Greg, and other times we don't. And we want to live on the Elon Musk dream of robo-taxis and robots.
I'm there.
Manus is ready for that world. But it does feel like there's been more analysts coming out and saying this. I talked with Tom Naranyan of RBC last week, who said that the driving force of Tesla's valuation, and for him this makes sense, is robo-taxis. Barrett is also out with the note saying that they're all looking to the August 8th robo-taxi unveiling event. So how much does this drive Tesla, especially if we're going to get some weaker numbers coming in?
Yeah, I think it does drive them from a financial perspective and earnings, but it is very important to acknowledge that that doesn't necessarily always matter with the retail crowd that is fervently behind Elon Musk, as evidenced by the vote just a couple of weeks back on his pay package. Despite all of the issues that the company has had of late, they remain firmly in his camp, and I think his ability to sell investors on this sort of next dream or dreams is really what it sort of speaks to why the stock has done what it's done. And we saw yesterday Wells Fargo come out with a very bearish note about sort of the outlook for Tesla this quarter, and the stock nevertheless went up 6%, and really for no sort of material reason. I think people are looking ahead to the robo-taxi unveiling in August. But I think it's important to remember and keep in mind that, robo-taxis are something that, this company has talked about going back to 2016, and actually executing them is a whole nother matter.
Yeah, Manus mentioned this to me, that their price target, Wells Fargo, you mentioned it at 120. Tesla currently trading at just under 210. Craig, thank you so much. Bloomberg's Craig Trudell. Okay, let's get you a check now on Paramount shares in the pre-market, up more than 3%, nearly 3.5% this morning. The New York Times has reported that Barry Diller is considering a bid to take control of the company. Joining us for more is Bloomberg's Charlie Wells. Charlie, okay, every single day, every week we come in, and
want this to be over.
There's still another Paramount story. Someone else trying to make a bid after the whole Skydance debacle. I mean, what about this time? Is this thing real? Are we finally able to stop talking about who's going to buy Paramount?
Danny, this feels like a Hollywood rematch coming to a boardroom near you this summer. Another twist and turn. And look, Barry Diller actually controlled Paramount in the 1970s. He's credited with turning around Paramount Pictures. He tried to bid for the company in the 1990s and actually was failed in that bid by Sumner Redstone, the father of Sherry Redstone. So this is a lot of drama. This is something of a rematch in a lot of ways. What we know is that Diller has signed a non-disclosure agreement with National Amusements. That is the controlling shareholder of Paramount, the parent group of the likes of CBS, of MTV, of Paramount Pictures. Now, non-disclosure agreements are very important in the deal-making process because they allow for the exchange of confidential information. This is according to that New York Times report, but still, the people familiar with the matter who were mentioned in that report did not indicate how far along the deal is. So I can't necessarily answer that question, but we do know that this is yet another turn in this saga.
So the bottom line is, what is Sherry Redstone going to make of this particular bid? How's that going to be received? Because that's the critical key that unlocks the road forward, isn't it?
Absolutely. So this is big franchises, but this is also big personalities. So I mentioned that history of the Redstones, of Sumner Redstone actually outbeating Diller back in the 1990s. And we know that Sherry Redstone fought a long, hard battle to take control of National Amusements. As she attempts to sell this company, it's also going to be a long and hard-fought battle as she tries to offload it. But look, the deal that potentially could emerge here, which would potentially be taking control of National Amusements, as opposed to the sort of merger that was proposed by Skydance just a few weeks ago, that could potentially be a neater transaction, and that could potentially get less shareholder pushback than that Skydance deal.
Fingers crossed, Charlie. Charlie Wells there from the Bloomberg team. Thanks so much. Okay, some other deals news that caught our eye, Manus. I love this. So the Boston Celtics win the NBA title. And then what happens? The owners decide, hey, let's sell high.
Yeah, well, let's face it. They paid, what, $360 million. That was 22 years ago. So this is a moment to just capitalize. And, I mean, there's a real flurry on sports deals at the moment. You've got to say. There might be a frenzy in the bond market, but you know what? there's a real sort of desire to get your hands on trophy assets, excuse the pun.
No, it's true. I mean, he probably has more buyers now. This is Wick Rosebeck, who's the owner who led this club deal in to do it. But I kind of think you get this hint that maybe not everybody wants to sell. Stephen Pagliuca, who's over at Bain Capital, is also an owner in the Boston Celtics. He also is an owner of Atalanta, who's done incredibly well winning the Europa Cup. But he tweeted this. A long tweet, this is part of it, saying that I hope to be part of the Celtics moving forward and will be a proud participant in the bidding process that has been announced today. But I hope to be a part of the Celtics. That doesn't sound like a man who wants to be gone. But of course, because Rosebeck is the majority holder of this, he can make the decision. The other thing I was thinking, Manis, as a fan, you'd probably be so upset. You'd say, look, this is the winning combination. This is the owners that took us to the big win, and now they're giving it up. Famously, new owners can be really bad for teams.
Yeah, but you can begin to understand what tempts people in. If you just think of some of the media deals that have gone on at the moment and the valuations that are there, and they're in the middle of a mega media deal frenzy, $76 billion of media deals between ESPN, Comcast and Amazon. So even though you can sort of say it's nostalgic and it's wanting to be involved in sports for the glory of sports and for the winning and for the triumph, $76 billion speaks an awful lot about what's in the game.
Nostalgic, it's the here and now. They just won, Manis.
Yeah, but that's 18 in a row? Sorry, 18th NBA championship, excuse me.
I mean, they're doing really well. I mean, why would you want to give this thing up? I guess for money.
For money.
Oh, he did say that it's for family planning in his state. That's why he was doing it.
How do you spell money? M-O-N-E-Y. Okay, coming up, we've got Jolts. It is Jolts Day. And a little bit more central bank speak for you. That'll be coming from Sintra through the day. Stocks are lower. It's a glorious day in this New York City.
It's your Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's get you set for your trading day today. We're going to be hearing from Fed Chair Powell and ECB President Lagarde. They're speaking at the ECB Forum in Sintra, Portugal at 9:30 a.m. Eastern. We're also going to get some economic data. Numbers for job openings come at 10 a.m. Eastern. And then, as we were just discussing with Craig Trudell, Tesla will report its second quarter deliveries before the bell. Manis, I know you're looking at Tesla and some other stocks there.
Yeah, it's down 1.2% with a number of different analysts come out. It had a nice 5-day run, to be fair, so it's giving a little bit back. We're nervous ahead of those numbers. NVIDIA falling following a report. This was yesterday, really. The French antitrust enforcers are preparing to charge the chip maker with antitrust practices. Tesla's down at 1.2%. And then you've got GameStop down 0.7%. That lawsuit accusing popular stocks influencer Roaring Kitty of engaging in pump and dump scheme involving GameStop shares. And it's dropped within days of the filing. So that's the state of play on three that we're watching. Danny.
Yeah, Manis, let's just get back to that yield curve because we've been talking about it steepening. It has turned to flattening this morning. This gets to this idea of how much can you really trade the Trump trade. Again, we've heard house after house come out and saying it's a steepener, but look, some of it's already starting to dip back, and it's hard to tell on that chart. But how enduring can this really be?
Look, there's a real frenzy. I think when you and I came in, it was, what, 13 bips over 2 days. A couple of people have been sort of saying to us, look, it really only becomes concerning for the Fed once the break-evens break another 20 to 30 basis points higher than here. I'll leave you with a line, which is this as good as it gets? That's from Mislav Mateshka from JPM.
Well, I like from RBC, Lori Calvasina, it is a fog. Fog for this half of the year and next. Surveillance, take you through the fog next.